Hello, I'm here today with Judith MacKenzie, who's partner and lead fund manager of the Downing Strategic Microcap Investment Trust. Judith, thank you so much for your time today. Can you tell us a little bit about your career and how that ended up with founding Downing Investment Trust?
Yeah, absolutely. So I started, dare I say it, about 24 years ago as a small cap or microcap analyst. Not that microcap was around in those days. And it was in the years when I was a TMT analyst, so when markets were going like that. Quite a difficult challenge to try and value those types of companies. And then quite quickly moved into the fund management side with Aberdeen Assets. And it was a real privilege. I got to invest in both private companies and those on the USM or the AIM market. And having that insight, sitting on the board of a company that had maybe been a university spin out and also investing in AIM companies, I could see there was a fantastic opportunity to use more of the diligence style that you find in private equity and venture capital in these little AIM companies that actually, by their very nature, were almost quasi-private anyway. And I spent about 8 or 9 years at Aberdeen cutting my teeth on fund management, and then quite deliberately went off to start this kind of mandate where we're taking more strategic stakes in smaller companies.
And how would you describe your investing style?
I always have a bit of a debate sometimes as to whether you should put yourself in a bucket of value or growth. I like to buy good companies and good earnings at a reasonable price. So I'm not scared of growth, but I want to be able to price it in from day one.
And that's more difficult with the market conditions as they are now. So do you vary your strategy according to market conditions?
No, not at all. We are very much bottom up, and we look at fundamentals and quality of earnings. So the strategy actually hasn't changed in the 15 odd years since I started deploying it properly. I think if you start changing it, then you don't really know where to go back to.
So what criteria are you looking for in companies that you're going to buy into the investment trust?
So we take strategic stakes of between 3 and 25% of the underlying investment. We're looking for a catalyst of some sort to realise value, and fundamentally we're trying to invest at what we believe is a discount to the intrinsic value of the business.
And so what sort of growth are you looking for?
We're looking for 15% compound growth over the long term, which sounds quite ambitious, but actually if you look at this area of the market over the last, since 1955, since the Horgevet index started, it's managed to achieve that.
So that's 15% per annum?
Compound per annum over the long term, not like that.
Yeah.
Doesn't go like that. But what you find from these types of investments, especially once you put some of the strategic catalysts in place, is that you can get non-index correlated returns. So we're looking at between a sort of 3 and 7 year investment horizon. So it is quite long term.
And what happens when you buy in and it doesn't quite go in the direction you expect it to?
Share prices never ever go in the direction you expect them to. That's the only thing I can guarantee. So what we care about is making sure the fundamentals are right, and you get the fundamentals right, either one of two things happens. Either the market does actually start to recognise things, and the other element is if you've got a strategic stake and the market doesn't recognise it, then if we've done our due diligence properly, then we should be able to sell that to a trade buyer. And actually our best returns have been from trade exits. So we're very engaged with the management teams to make sure that they're aligned to be thinking about trade exits, should they be there.
So what qualities do you think you need to be a good investor?
I always used to start off this by saying that you needed to be a CFA minimum level 2, you needed all the tools in the toolbox to be able to drive a spreadsheet. But actually as time's gone on, simple traits like being a little bit courageous, having passion for what you do as well is really important. You've got to have a degree of inquisitiveness and really want to dig and find out more. And I think in fund management, you do have to have a sense of self-reliance as well. And the numbers, I'm not saying they come secondary, but they probably are the easier bit to put together as opposed to some of those other traits.
And how much is patience important?
Exceptionally, especially in the type of investments that we do as well, because you're not going to see things going off to the races overnight. We are masters of our own destiny to a certain extent. We are capable with the management teams of being able to put those catalysts in place and drive things, but they don't just happen overnight. So you do have to have patience.
Presumably with the patience, you have to have confidence, because you have to believe in what you're holding on for.
Yeah, that courage of the convictions, but without being. And these kind of traits you can very often find in people, but you always sometimes have arrogance as well. So you cannot, in my view, you shouldn't be arrogant as a fund manager, because, well, you never know really what's around the corner. The difference between an investor and a fund manager is that the fund manager is constantly in the spotlight, and you live and die by your performance, which is public information, obviously. And it's a really difficult place to be sometimes. And it's a bit like going back to the days of Tony Dye and PDFM, when he was Dr. Doom, where he was telling the world that that valuations were too high, and he stuck with that for a good number of years, and then it came true. But actually, you do need to stick to the fundamentals and have courage to reiterate them without being blind to some obvious facts sometimes when the investment case changes, and then you have to just get out of things.
So in terms of managing your fund managers, how often do you assess their performance? Because I've heard horrible stories of people that are sort of assessed virtually daily, and that doesn't seem most constructive. What's the optimum?
I don't know what the optimum is. I think, and the fund managers that we have here all have those character traits that I've just talked about. So I don't need to beat them up if a share price has gone down. They beat themselves up about it. So actually it's almost the opposite. And what we've got a very collegiate team. We sit down, we talk about the underlying investments and what's going on in the portfolio. And I think that's really important, because we can go back to that original investment case. And if something is going slightly awry, a share price is going south, and we don't understand why it's going south, and our diligence says X and the market seems to be saying Y, then we can figure out whether to buy more or whether to do some more work on it. But it really is, it's a tough job for a fund manager, and I think it's great when things are going like that, but it's much more difficult and more challenging for a younger team that are maybe a bit more inexperienced. So I don't haul anybody over the coals for short-term underperformance. It's just not what I think. It's not conducive to a good team atmosphere.
So it sounds much more a team decision as to how you deal with the situation.
Yes, yeah, and because there's no ego, I think it makes those decisions really easy. So if you've got the investment case, you know what's happened, you can price that in, you go back to it without any agenda, and very often we collectively come to the right answer. But the lead fund manager on that position gets the help to reach the right decision. And none of us around the table actually know what that right decision is. And it sounds rather collaborative and sort of collective thinking. I think it's because it's a small team we can get away with that. If it was a team of 25 or 30, then it'd be slightly different.
So taking ego out of it sounds very impressive.
Yes, and again, going back to when I was putting the team together, it was important that you had courageous, brave, confident people, but arrogance is not. It's just not conducive, and ego is not conducive to having a straightforward discussion.
So how much do you think psychology takes a part in investment decisions?
Probably more than we actually think in the end. I've often said that our job is a cross between a forensic accountant and a psychiatrist half the time. And we can't get away from the fact that we're buying management teams and backing management teams, and therefore understanding motivations and the way people behave, especially under more stressful situations, is really quite important. None of us are trained as psychiatrists in psychology, but I do think it plays quite a material part of the investment process. And we spend as much time as we can with management on site, in meetings, but mostly on site really. And that is not to catch them out, but it's actually to try and understand how they tick and actually making sure that they understand how we tick. So if we've got a decent stake in the business, we've got that alignment from day one.
So talking about management, you've got Ramsdens in your portfolio. It's about 9.4%, I think. And management sold about 1.7 million at the end of June. And the share price has been appalling since. What's your view on that?
Not helpful. There's never really a right time for management to take cash off the table. With this team, we were always aware that the lock-in was coming off this summer, post the IPO. And we were also aware that this is a team that had not necessarily made a lot of money in the past for themselves, and that there was probably a sensible time, and given not that they're old, but a sensible time for them to think about paying down some of their mortgages and whatever. So that was always our understanding. It's disappointing to see that actually we believe that there was demand in the market for the stock, and that's why they were selling. So it wasn't being pushed into the market and pushing the price down. It was being done at a sensible level. And they still have got decent skin in the game as well. So I'm comfortable enough with the management aspect. I'm as frustrated as I often am with the way that microcap stocks react to anything that's negative news. And we've seen this a number of times in our portfolio over the last 12 months or so. So our job then is to actually make sure that they're getting the message out there as to what the core of their business is doing. And if there is demand for the stock, then those new shareholders continue to buy.
Do you think the situation could have been managed better?
Yes, and there's a big debate because MAR rules obviously came in a couple of years ago. A number of companies would have perhaps approached it in a slightly different way, and that would be to have a managed process where institutions and groups were maybe put inside, knowing that it was director stock that was coming. It was actually pretty obvious that it was director stock that was being placed out. But so actually having that formal process and having it placed and maybe fully oversubscribed, not leaving any stock in the market, that is a different view to the view that the broker took.
Now, managing other people's money. What are the good things about it and what are the difficult things about it?
I think the best thing is that it gives you a real sense of accountability, and you can't take that away. I think you every day you wake up knowing that you're managing somebody else's money, and I think one of the I always make sure that our managers go out, and we manage some AIM-IHT portfolios, so therefore we're managing portfolios on behalf of normally people who have retired and who are thinking about their nest egg and being able to pass it on. I always make sure our fund managers go out and speak directly to those investors, because and I remember specifically even just about a year ago seeing an investor in Kendal, two doctors who had obviously worked very, very hard throughout their life. I sat in and I did my presentation on what was happening in the portfolio, and he listened attentively and asked a few sensible questions. But at the end, when I was standing up to say goodbye, he said, "Look, you do your job in the portfolio. That's your job. Just remember, I've worked 40 years for this money, and I've got 5 grandchildren. I'm doing this so I can preserve this to be passed down to my grandchildren ultimately." And I think that kind of wake-up call, where you know that you're not playing around, you're accountable to these investors. That's the real privilege. And it's also the negative, because when things are going in the opposite direction, the sense of disappointment and the inferred disappointment that you're giving to an investor is tough. And so that's the negative.
Do you get a lot of grief? Do people get in touch with you and express their opinion, either positive or negative?
They never do it positively, do they? Negatively, yes. Yeah. But we will make sure we take every single call. Yeah. And we don't pass it off to a sales team or whatever. Clearly, if we're not around, our support team know what the headlines would be in response to sometimes a stock that has fallen. But we would automatically get on, as individuals, as fund managers, get on the phone to those investors. And once you've spoken to them and talked through why you're maybe continuing to hold something and what your plan of action is, or sometimes why you've sold out of something, then people tend to be pretty rational.
So what is your outlook for the small cap market?
I think this is a great space to invest in. And I think it's been a great space to invest in since I started my career. And nothing's really changed, actually. The opportunities are still there. I like what we do in being able to have the catalyst in place, take these strategic investments and actually drive our underlying performance ourselves. I think from a market perspective, it is slightly difficult because you go further up the market cap scale and the valuations are stretched. You can't help but see that valuations are stretched, which is why we quite like playing where we do down the market cap scale. And
what's the largest market cap that you
we go up to about 150 million market cap, but our median market cap at the moment is about 69. So we are playing in the small end of the pool. And we don't find that valuations are overly stretched there, but they all need a little bit of help in tweaking. From a sort of general market perspective, if valuations are pretty much at the highest as I've seen them be for the last 8-9 years, and you see the market being quite risk off. You're seeing PwC just put their quarterly report out yesterday. It's the highest number of profits warnings in the market there's been for the last 2 to 3 years. That to me is a bit of a risk warning as well. So I think we are going to see a correction of some sort. But that if we're long-term investors, 3 to 7 years, that's a brilliant opportunity for us. But there's going to be bumps along the way, inevitably.
When do you see the next bump happening?
I've been saying it's going to happen for 2 years, so don't listen to me. I think soon.
Yeah. How does your own personal investing differ from what you do with Downing?
It's changed over the years, if I'm being perfectly honest. I was quite defined in what I wanted to create in terms of Downing public equity and the strategy that we had or have. At the same time, my own personal investment style is completely erratic, and we don't invest in anything that's blue sky and tech and early stage, where in my own portfolio for a while I was just going a little bit off the rails. So I brought that back in-house, if you like, and I only invest in our own funds now.
Oh, very
so
good.
I would say, and my financial advisor is not happy with it, but about 60% of my pension fund, where I have most of my investing assets, is in our own funds.
So what was the most blue sky that you invested in that was a disaster?
I don't want to talk about it. I can't, it's too painful. And actually some of these companies are still around today.
Yeah. Judith, thank you very much indeed for your time today.
Thank you.